All right, stocks took a breather today after a couple of 1% down days in a row that in the past has started some new legs lower to the downside. So now the question is whether or not this little 5-day streak that we've been on since the cluster, actually we got the cluster on day one of this 5-day streak, but has there been enough technical damage here to be able to, that would lead us to the expectations of a new leg lower to the downside. So I'm going to break that down in today's chart. There's a difference with today's move, or this week's move, this past week's move, than what we've seen in the past in relation to how stocks and bonds have moved with each other. So I'm going to show you that, and this really, really big move in bonds. So we'll take a look at that. We'll also take a look at sector rotation. There's a significant shift going on in sector rotation. So we'll trade. And our trade idea actually will come out of that. We've had a few lately, and today's as well will come out of that major shift that we're seeing in that rotation. So let's go ahead and get started. Today is Wednesday, December the 7th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I'd invite you to subscribe to our YouTube channel with this icon here or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these things on the right, including our Market Outlook live video and our upcoming classes that we have. Let's come down here to the bottom. You can see we have, if you click on this heart, it opens up this tab. Hit that like button. Same thing here with this thumbs up icon. It opens up this tab. Hit that like button as well. Again, the more you do that, it helps get our content out to all of our followers on that social media, on those particular social media platforms. All right, let's start off taking a look at the S&P 500 here with the market forecast indicator. You can see, it was a fifth straight down day. Wasn't as much of a down day as what we saw the last 2 days, so we avoided the 3 consecutive 1% down days. But as I mentioned to you in a tweet here yesterday, this was the last time that we started a run like this with 2 consecutive down days, and then that was August, and then in April, let's see, it was these 2 days right here were 2 consecutive down days. That's what started both those legs, and it appears that we may be getting 2 consecutive down days the last 2 days going into today that may be leading us off on a bearish run now. The intermediate line is below the 80th percentile now, so we do have that weak bearish posture going. The short-term sentiment is relatively bearish. It's not extreme. Neither one of those have dipped below the 5th percentile. But they're both in the lower reversal zone, pretty easily in the lower reversal zone. So we've got established here, and you can see market sentiment's rising, but it's still really far down there. That's not the case for the Dow Jones Industrial Average. The Dow Jones, that market sentiment line's in bullish territory now. It's up there, it's at 59.9, so it's going to be up there tomorrow, most likely, or at least close. Intermediate line's actually still above 80. And short-term sentiment's just dipping its toe below. So the Dow Jones actually looks a lot better than the S&P. On the other hand, the NASDAQ has been looking a little worse. It actually not only has a yellow or light pink shading because the intermediate line dipped below 80, but it actually has a red line, right, where instead of flipping to the yellow, the light green shading, pink shading, in the yellow line. So just like that, you're already red. You're a little bit below the moving average by 0.03%. So this has been the most bearish one. You can see it's below. We dropped back below the 38% retracement of this current intermediate run that we're on. SPX, there's the 38% line. That's actually back below 38.25 or so, 38.20. That would get us back below that 38%. So that's kind of like in this area. That's what where the NASDAQ is relative to the S&P, and of course the Dow, if you recall, is nowhere near that level. This big microphone in my way here. So the 38% line's way down here. So The Dow would be here if it were the NASDAQ where my cursor is. So that's a long ways, a long ways to the downside there. A lot more of a stronger pattern that we're seeing. But, you know, if you look at some of these other oscillators like the whole moving average here, you can see, I mean, that's a pretty bearish pattern. You're below the 20-day Hull. It's falling. That's why it's red. You got bearish candles here. You've got the parabolic SARs flipping to the upside. The actual price is below its moving average. When you look at like the stochastic indicator, you know, it's dipped below its moving average. It's not quite below in the lower half of the chart yet. That would be another key sign. When you look at, like, there's a few indicators that when we drop below, we're making our way down. One of them being the McClellan oscillator turning negative, which it has. So that means the summation index is rolling over. And then the other one here is the money flow index dropping below 50, and it's down to 46. So pretty clear indications on both of those that when you combine that with like that stochastic indicator here dipping down below its moving average and potentially below 50, you know, you can kind of see why and how we're a lot more bearish here, especially coming off of a cluster, an overbought cluster, than we have been for a while. If you look at the DMI for SPY, the positive indicator is still up above 25. The negative indicator, though, is also above 25. That doesn't happen very often, but obviously when it does, when you get both lines up there, it tends to be when you are on these, when you've been on a bullish move and now we're not, right? Now we're making our way with both lines up above 25 during a bullish rally, at least potentially towards the tail end of a bullish rally. If we were to look at like the RSI and the CCI, the CCI has dipped below zero, so it's in bearish territory. It needs to dip below minus 100 to really solidify that, so we're not quite there yet. The RSI dipped below 50, but just barely. It's got to dip below 40 to really solidify the breakdown into bearish territory. So you can kind of see just how close we are, how on the cusp we are to things really turning to the downside here. You can see we are in the lower half, but still not in the lowest quartile yet. And then when you look at the Keltner channels, the bands are still outside the channels, and they're working their way back inside of it. So they're about to turn red, and of course we all know that when you get the red bars, you tend to get a reversal pattern. In this case, down the up. In this case, it'd be down the up as well. And briefly, you had a down, and then this rally up before continuing to move back down. So I think we are looking at the potential for a rally. And this, we never did get the red arrows during that turn, and we briefly got them over here before you rallied, and then one day as we were rolling over to the downside. So we'll see if that ends up being the case where we roll over here. All right, when we take a look at where we're closing relative to these major moving averages, you are still below the 17-day moving average. So if we were to get back above it, we'd feel really good about things. And obviously getting back above 400 on SPY would be important. 4,000 for SPX. But again, you have the MACD breaking down below its moving average, still positive, but it's working down towards its moving average, and the stochastics is also out of bullish territory, working its way towards the lower half of the chart. So you can see and you can see so far we failed on this breakout move to get not only above 4,000, which is a key, multiple Fibonacci levels in this area, as well as it just being just a big round number. We also kind of broke out the 200-day moving average, looking like we might, kind of turn the ship around since we didn't do that in August. And now maybe we will do it here, but 5 days later and not so bullish anymore. Now let's check out the intraday chart here. I'll come over here to this one. And you can see it was an inside day. This really at the bottom of yesterday's channel. Still holding this midpoint, pretty much last week's low, this midpoint of the 4-week range. Now keep in mind that after this is done, the low point moves up considerably. So, and the midpoint of the range is also, we're going to be in the lower half of the range. And then the value area you can just see is, I mean, all the volumes above us, and there literally is hardly any volume below us. So things will change pretty dramatically here. We won't quite have, here, let's go to, here we go. We won't quite have the pattern of the green line falling below 70 yet. We're probably still a couple more days away from that. But the red line has dropped below 0. We are at 79, 78 on the green. So we are getting close, and we are back below 10%. Again, when we break, we will typically break the 10% mark. You can see over here we actually dipped down to closer to 5% before we finally broke through, and then before this run we were dipped down to right around 5-6% as well. The VIX also is telling a little bit of a pattern that appears to be that we may be turning around here. Let's get to this one here. Again, back up above 22 after dipping below 20 briefly, back up above 90%. So there's going to be some resistance in this area. But what's really moving is the relative strength is back to strong levels. That typically leads to a renewal of volatility to the upside, combined with a renewal of the volatility of the VIX to the upside. And you can see it's still pretty darn low relative to its historical average. So there's a lot of room for this to move up, which typically coincides with a bearish move on equities. All right, now let's take a look at what's driving the price action. Let's go back to the last 5 days here. So this would be after the move, strong move to the upside. Got us through 14,000. Let's go to December, starting on the 1st. Let's go like 15 minutes. You can see stocks have been all down. The Q's down 4.5%, IWM down 4%, SPY down 3.5%, emerging markets down 1.75%, developed markets down about 1%. Excuse me, commodities getting hammered down more than 6%. Bonds really moving strongly to the upside, up 6.59. Even the dollar was down. Bonds moving to the upside. Typically this year, when we've been in a risk-off environment like we have been for the past week, commodities and yields move higher. So bonds are down with stocks, commodities are up, and the dollar is up. In this case, it's the opposite direction. Commodities are down, dollar's down, and long-term bonds are up, and up quite a bit. In fact, I showed this in my class here today. This is one of the bigger 5-day moves on TLT that we've seen in a while, absent, outside of, the COVID weirdness, right? If you look at the 4-day move here, you can see we're up over 6.5%. That's a high level. Obviously, we were the same, we also had the same move, but the difference between this move and other moves where we had strong rallies here, especially recently, is that over here on some of these other rallies, when the long-term bonds rallied, you can see stocks rallied. Long-term bonds rallied here, stocks rallied during the same period. Not the case this time. Long-term bonds rallying over here for 5 days, stocks actually falling over the last 2, 3, 4, 5 days. So a much different environment than what we have seen in the past. So as a result, when you look at like the 2-line version here, let's look at it right with this one. As a result, when you look, nope, sorry, this is not the one I wanted. This is the one I wanted. You can see just how big of a move. I mean, breaking above the 23% retracement line for the first time. Obviously, still easily below the point of control for the past year. Still easily below the 200-day moving average. So we're not anywhere near like a long-term trend move. But it's been quite the rally. In fact, off of that, what is this? The November 7th low point. You've had quite the move. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21. So essentially it's a 21-day rally that we're currently on. So if I were to change this to 21, which is essentially a month, pretty much exactly a month, you can see the monthly returns, the 1 month rolling window returns there has been pretty positive. At least it reached the 10% mark to the upside. We'll see if that in turn leads to a 10% move back down and the other direction. When you look at the sector comparison, so we'll go to the sector, nope, that's the total grid. Let's look at the sector move here. There we go. Let's look at just the last 5 days here. Starting on the 1st. 15 minutes. You can see this is a typical risk off pattern. You have energy down, that's been one of your big winners today. Discretionary, communication services, technology are all down 4 to 5%. All the cyclical areas are doing okay. Materials and industrials and real estate doing okay. Financials and energy are not. And they're kind of your bigger weightings right now, and that's among some of those other smaller sectors. But you can see at the top, that's your typical risk-off trade. Healthcare, utilities, and staple are all healthcare oriented. They're all safe haven sectors within the U.S. You can see they had the most demand today, even if it wasn't above zero on an absolute basis. It was above the S&P, so we didn't sell off as much as the S&P did, and appears to already be moving a little bit higher there on their own, potentially without the S&P. All right, now let's take a look at how the sectors are performing here, and you can see this is over the past week, going back to that same December 1st time frame. This is classic risk off, right? You can see XLK, XLY, XLC, all lagging down 4 to 5%. Energy struggling down 6.6%. Financial struggling with that yield curve inversion down nearly 5%. And then your safe haven areas outside of real estate's kind of been lumped in here with these other areas getting really hammered. But you have the rest of them. Healthcare was almost flat for the day. Utilities was briefly up for the day. And then of course staples all down about 0.5 to 1.5%. All of those. You also see materials and industrials, interestingly enough, outpacing a couple in economic growth sensitive sectors there. So your safe haven areas outperforming over the last little bit. If I were to take a look at the 12 grid on the sectors here, again, your S&P 500 is at that light pink shading, almost the yellow line. You can see technology looks almost completely the same. Discretionary, though, is below its moving average. So is communication services. Financials is giving you that light pink shading in the yellow line. Energy is already broken down, is giving you dark pink shading in a red line. So that's the first sector, this has been the most bullish sector of the entire year. And energy is already breaking down pretty hard. XLI, XLB kind of looking very similar to healthcare and staples and utilities, so they're kind of behaving like their safe haven areas here. And then you can see real estate looking very similar to these two up at the top. So you can kind of get an idea of where the focus is in the markets. In fact, when you look at the relative rotation graph here, let's go here. To the weekly chart, you can see materials and industrials are really kind of moving up to the right, pretty hard and fast. Financials dropping down. It's really hard for them with that yield curve inverted as much as it is. Staples and healthcare are still showing relative strength, and you have utilities down there at the bottom along with real estate interest rate sensitive areas down there struggling, and then XLK, XLY, XLC also on the left hand side of the chart. So if you look at the daily version of this, that's the kind of longer term version. The daily version, XLY, XLC, we're moving up to the right, and so is healthcare. And your safe haven areas are kind of moving down. You can see energy moving down to the left, financials moving down to the left. Now industrials and materials are moving over to the left, so losing relative strength. Real estate and XLK starting to move down. So there's been a rotation into kind of some stronger areas with XLK, XLC moving up, and XLK for that matter as well. But materials, industrials, financials, energy, that's been the cyclical area. If you notice here, if I go out like 10 trading days, if you notice, those have been the areas that have been the most bullish here. You see over here to the right, you can see XLB, XLI, XLF during this rally here. They've been the ones that have been the most bullish, right? There's XLE, XLI. They're still continuing up to the right. There's your safe haven areas, actually doing pretty well. And then now they're starting to move down to the left. So we're losing the strength that we had in those particular areas, which again, that's why the Dow's been so bullish. That's not the area of the market you want to lead us higher. And XLK, XLY, XLC have been lagging behind, and they're getting some relative strength. But don't expect that relative strength to necessarily lead to a bullish market. I think you're just getting rotation into those areas because they've been such laggards during the past couple of months. So the rotation there is more out of these other cyclical areas, and they're just outperforming mainly because these areas are underperforming. It's the safe haven areas that you would expect will continue to outperform, and I think we've got a little while for that to happen, because if you look at these cyclical areas, financials, industrials, and energy still have the three biggest, three strongest relative strength values on this weekly chart. And then you look at materials and energy and industrials still have the three highest momentum moves. And then your safe haven areas, including utilities and real estate down here, and staples moving up to the right, and healthcare sticking over here too. So there's still a lot of room for that particular area of the market to show some relative weakness here. All right, so that brings us to our trade idea of the day. Let's take a look at Love, Southwest Airlines in that industrial area. We actually already have a couple of bearish trades in the energy sector, but you can see Love looking very similar to what we saw previously. I believe we did Schlumberger or Halliburton last. You can see it's we had a kind of a divergent pattern going on here with this higher high ending in the cluster, very similar to the broad market for that matter. And then today we really broke down hard, finishing below the moving average. So we got the yellow line. We didn't quite get the light pink shading yet because we're not below 80. That's how bullish we've been. And you can see we're off the low, so we're not nearly as bearish in the short-term sentiment. But if you look at that breakdown on Love here, obviously we got below the 30-day moving average. We also got below the 8 and the 17 at the same time. So we failed at the 200-day moving average, and there was a pretty decent gap between all three of these lines. That's how big today's drop was. We fell below all three lines with those gaps all at the same time, sitting at the point of control. But you can see the momentum down there. You can see there was a big jump in volume. In fact, I believe, let's see here. Yes, we should have all three red arrows now with that spike in volume there. So that's a little bit of a bearish pattern here. So there's your three. You have your third red arrow there, obviously, because you're below the moving average. I don't know why it's not showing up there. You got the light pink shading, which tells you three red arrows. And then you have that jump. So that's a pretty significant move to the downside. If you look at its Hakinyashi candle on the weekly chart, you can see it's setting up with a transition candle. I've always told our market scholars that when you get this transition candle like this, when the actual candle itself is pretty bearish, then that sets you up for a reversal for the next week. So we would expect that it will continue to move to the downside there. When you look at like the RSI and the CCI and just how strong this move was, we dropped below the midpoint of the chart after being above 60 and easily above 100 previously. In just one day, you're back into the low point, or the lower half of the chart there. Looking at the DMI and the ADX, this big jump, look at what it did to that negative indicator, getting it above 20. The positive, not quite below 25 yet, but below 30. So, we have this strong ADX because we had such a strong trend, and already it's moving in sharply in the other direction. When you look at the Ichimoku cloud, we're still well above the cloud, but look how we broke below the green and the blue line in the same breath, and look how close that 26-day rate of change is to crossing below zero. When the red line crosses below the price, that means the 26-day rate of change is below zero. So we've had this mature trend going on. I wouldn't expect this trend to last very long. We get another day or two of downside, and that's going to break that. These are going to drop to zero pretty quickly. And then when you look at the Bollinger Bands here, you get into the lower half of the chart, not quite the lower quartile yet, but you see the bandwidth is really small, and the bands are inside of the Keltner channels. Remember, we talked about how when you get the red dots, you can look for reversal between momentums. In this case, we've had bullish momentum, so you'd expect that we'll get a bearish momentum coming out of this. So with that being said, we took a look at the January options and did a pretty aggressive, because they're $2.50 wide. When I did a long put vertical spread for the 37.5, which was at the money, I get about a little bit less than the 2-to-1 reward to risk ratio. But when I go a little bit further out to 35, 32.5, and you can see, over here, the 32.5, right now, the January expiration is at 33.5. But you can see if we break down and break out of this Keltner channel and the Bollinger Band to the downside, you're also going to be breaking below the lower band, the lower chunk of the value area, below the point of control as well. And remember, also, we're failing at the 200-day moving average. You'd be breaking below the 50. There's nothing down here, so I wouldn't be surprised if we did go down, like the last time we failed at the 200-day moving average, which I believe was up here. Let's check that. Right up here. Last time we failed at the 200-day moving average, we dropped pretty sharply, and the last leg lower is also pretty sharp down. And you notice we're also failing at the 50-week moving average, so getting back below these lines would also be relatively bearish. And look at the momentum and the stochastics. So I think there's more downside potential. So I don't mind being a little bit more aggressive in January, going for a small risk. Here, so got that in there. Going for a small risk, my normal $500 risk for a directional trade. So if it bounces back up, we take a couple $100. But if it does break down, then we get that $2,500. So we're getting about a 5-to-1. Again, really aggressive. It's not too normal for me to go for a more than 1 standard deviation move. But I think you've got the potential on this setting up, like I said, for that rotation out of these areas, energy and industrials, into, not necessarily because the XOK, XOY, XOC will be bullish, but just because these will be so bearish that those other areas will outperform on a relative basis. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join our website at marketscholars.com for free. Follow us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.